The question is about diversification, and I've got a dual answer to that. If you are not a professional investor, if your goal is not to manage money in such a way as to get a significantly better return than the world, then I believe in extreme diversification. I mean, so I believe 98 or 99%, maybe more than 99% of people who invest should extensively diversify and not trade. So that leads them to an index fund type of decision with very low costs. Because all they're going to do is own a part of America. And they made a decision that owning a part of America is worthwhile. I don't quarrel with that at all. That is the way they should approach it, unless they want to bring an intensity to the game to make a decision and start evaluating businesses. But once you're in the business of evaluating businesses and you decide that you're going to bring the effort and intensity and time involved to get that job done, then I think that diversification is a terrible mistake to any degree. And I got asked that question when I was at SunTrust the other day. And if you really know businesses, you probably shouldn't own more than 6 of them. I mean, if you can identify 6 wonderful businesses, that is all the diversification you need, and you're going to make a lot of money. And I will guarantee you that going into a 7th one is going to, rather than putting more money in your first one, it's got to be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich on their best idea. So I would say that for anybody working with normal capital who really knows the businesses they've gone into, a 6 is plenty, and I probably have half of it in what I liked best. I don't diversify personally. I mean, and all the people I know that have done well, with the exception of, we mentioned Walter Schloss here earlier. Walter diversifies a lot. He owns a little of everything. I call him Noah. He's got 2 of everything.
We didn't lose money very often, and that's why I kind of wiped it out of my mind. We didn't sometimes buy a lot of stock because I was a little nervous about putting too much money in a stock, so we never put too much money. I owned over 100 stocks most of the time, and that way we had a big diversification.
We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood, and to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. And it's conventional practice, and it may, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. So, do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And And the truth is you don't need it. I mean, if you have a really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that I would rather pick, if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50. Charlie?
Yeah, what he's saying is that much of what is taught in modern corporate finance courses is twaddle.
You want to elaborate on that, Charlie?
You cannot believe this stuff. I mean, it's modern portfolio theory, and
it has no utility. But I mean, it will tell you how to do average. But I think anybody can figure out how to do average in 5th grade. I mean, it's just not that difficult, and it's elaborate. And there's lots of little Greek letters and all kinds of things to make you feel that you're in the big leagues. But there is no value added.
I have great difficulty with it because I am something of a student of dementia, and I have.
We hang around a lot together.
And I can ordinarily classify dementia, on some theory structure of models, but the modern portfolio theory, it involves a type of dementia I just can't even classify. No. Something very strange is going on.
Yeah. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it.
By the way, maybe that's the reason there's so much dementia. If you believe what Warren said, you could teach the whole course in about a week.
Yeah.
So we're acutely focused on risk. We think about diversification. We think about position limits. We think about industry limits. And at the same time, we think that one of the mistakes most investors make is overly diversifying, owning 101% positions and not willing to identify their very best ideas, trying to limit their losses by only losing at most 10 or 20 basis points on a loss. And I think that the problem with that is it presupposes that all your losses will be one-off events from a company having a particular problem rather than the whole market going down. If the whole market drops 40% and you have 1% positions or 10% positions, you're probably going to be down around 40% either way. So we don't think that actually provides the comfort that people take from it. And what it really does is limits your return. If you can tell a good idea from a bad idea, something to buy versus something not worth buying, how can you not tell a great idea from a good idea? And so we're very comfortable that we'll have 3 and 5 and even 8 and 10% positions from time to time, and that overly diversifying actually eliminates return and doesn't really defend against risk very much.
Do you think diversified index funds adequately protect the amateur investor from losers?
Well, this is a great question. The role of the index fund. A lot of people say, I'm going to take a low-risk approach. I'm going to invest in an index fund. And they are confused. What an index fund does is it guarantees you performance in line with the index. So the point is, because of the operation of what's called the efficient market, Not many people can beat the market. It's true. Most mutual funds do not beat the market. Most mutual fund investors would be better off just being in an index fund. And in fact, most active investment schemes impose fees that they don't earn. And that is one of the major reasons that most active investment schemes perform below average. So the index fund, which is called passive investing, yes, it does reduce, it eliminates the likelihood that you fail to keep up with the index. It also, of course, eliminates the possibility that you outperform the index. So you trade away the two sides of the probability distribution for surety that you get index results. So, but it doesn't eliminate the risk of the investment. It eliminates the risk of deviating from the index. What you have to keep in mind is that the index fund investor loses money every time the index goes down. Why? Because there's no value added to keep it above. So, by the way, index investing is a fine thing for the average amateur investor, because the average amateur investor, number one, can't beat the market. Number two, can't find anybody or hire anybody who can beat the market. But the only thing is, he shouldn't think that it's a riskless trade. It's you eliminate what we call benchmark risk, but you retain the risk of the underlying assets. So there's been a strong movement toward index investing. It used to be something of a novelty back in 1975 or even 85. And today it's a real thing, and lots of people are replacing their active managers with passive, largely because the actives didn't do any good. But as you point out, Jason, in passive, people just buy the same stocks in the index in the same weighting as the index. Now, the irony of this, before I move on to your real question, I just want to point out what I think is the supreme irony of this, which is, why do the stocks in the index have the weighting in the index that they have? Where do these indices weightings come from? They don't come from up there. They don't come from the operation of nature or physics. This stock has a value of $80 billion. That company has a value of $180 billion. Why? Partially because what the companies accomplish, and partially because of what the investors say they're worth. So the market weightings, the prices, and thus the weightings are assigned by whom? By active investors. And yet there's a trend to passive investment on the premise that the active investors don't really know what they're talking about. And yet, the MO of the passive investor is to emulate the decisions made by the active investors who they think are idiots. So it doesn't make any sense. Anyway, that's what passive is doing today. And we have to wonder about the wisdom of passive investing. And so one of my clients called up and said that she has a new treasurer, and the new treasurer wants to put the whole portfolio into an index fund, all the stock. Fire this manager and that manager, not us, we don't manage equities. But put all the money into an index fund. What do I think? What should she say to her treasurer? I said, ask him how he feels about having all his money invested in funds where nobody is thinking about which stocks should be included or what they're worth or how they should be weighted. Anyway, so I think that's a very extreme thing. It used to be that the active managers did all the work of studying companies and figuring out the prices and the weightings and all that stuff. And so if a few people came along and wanted to kind of free ride passively on their efforts, they could just emulate their decisions and not pay the research bill. That was a good strategy. But what happens when most of the people are free riding, who do they free ride off of? That's the question that I think you'll enjoy thinking about.
You maintain that the individual investor can beat the big guys, as you put it. How can that be?
Well, it's pretty interesting from the research we did in the book. Most people know that the typical index funds, the S&P 500 and the Russell 1000, if you invest in those, they beat most managers, roughly about 70% of the managers. And that's pretty powerful. It's because of their low fees and that most managers aren't really adding value. So one logical thing to do would be to say, well, I know only 30% of the managers beat the typical index, so how do I find those guys? And it turns out if you look back over the last 3, 5, and 10 years of those managers' records, there's really no correlation between how they do in the next 3, 5, 10, which is really what you're trying to figure out. So that's why many at least advisors have recommended, and possibly rightly, that index funds for the individual investor who doesn't know how to pick stocks on their own is maybe a good opportunity for most people. So we set out to do something a little better. And as it turns out, the regular indexes, the S&P 500 or the Russell 1000, are seriously flawed, as it turns out. Even though they beat the most active managers, they're still very seriously flawed. And they do something that costs investors about 2% a year. And that really is that they're market cap weighted indexes, which means they put more weight into the larger market caps. And so that if a stock...
the losers.
Right. So if you believe like Ben Graham or Warren Buffett that the market's sometimes emotional, it's not efficient like so many professors have professed over many years. It's not efficient. That means that if the market does get emotional over the short term, that some stocks are overpriced and some are underpriced. And a market cap weighted index, if a stock is overpriced, it buys too much of it automatically. And if it's underpriced, it buys too little of it automatically because it's based on market cap, which is essentially price. So it sounds crazy, but it actually is systematically doing the wrong thing at every point whenever there's an inefficiently priced stock. And so there's an easy way to correct that. And there are actually equally weighted indexes. Instead of putting more in the larger market cap companies, it actually puts an equally weight. So if you have the S&P 500, it'll put as much weight in stock number 1 as it will in stock number 500. It still makes plenty of errors. In other words, it's an equally weighting, but those errors are now random, not systematic like a market cap weighted index. So you actually get back the 2% a year. And a few people have come out with something called fundamentally weighted indexes. It's just another way to weight stocks without using price. And therefore, the errors in those indexes are also random, and you get back the 2% from those too. And since we're value investors and have done a lot of research on value investing over a long period of time, we created an index that we call value weighted, which just means the cheaper something is, the more weight we put into it. And it's actually more diversified than the S&P 500 or Russell 1000 index. Has the same volatility, has the same beta, yet over the last 20 years you would earn 7% more a year following that strategy. And it's ridiculously simple. Just put more weight in the cheaper companies.
So you've been through one or two of these business cycles,
Yes.
I guess, and with the availability of information and with the number of books being written about this subject, about value and proper investing and how many managers don't beat the market, do you think the average investor is doing anything different than they were 20 years ago?
Well, look, I think there's a minor movement toward indexation. It's not a groundswell. There's still lots of money in actively managed mutual funds where there's 2% a year of fees and costs, or 1.5%. But I think there's more in indexation every year, and that's probably appropriate. But I'll just turn it around. I'll leave you with a question. Why can't people beat the market? Because the market's pretty efficient, and market prices most things right, and most people can't find and identify and act on the times when the market prices things wrong. That's why most people can't beat the market. That's what I learned at the University of Chicago, and I think it's pretty true. So the reason for the inability to beat the market is the market's efficiency. The market's efficiency comes from the concerted efforts of thousands of investors who are trying to find the bargains. what happens when they stop trying? So when the interest in active investment declines because people give up on it and turn to passive investing, and all the analysts quit studying the companies, then prices resume their deviation from intrinsic value, then it becomes possible to beat the market again. So it's really paradoxical, and I would say counterintuitive. But I don't think we're close to that day. But in theory, there comes a day when so little attention is being paid to active investing that active investing starts working again.
Charlie, another question comes in from Chris Freed of Philadelphia, Pennsylvania. He says, you've recommended the use of an index fund for the average investor. As these index funds continue to expand in size, their influence on corporate boards and ultimately management is ever increasing. This concentration of voting in the hands of a few index funds is alarming to me. Do you see this concentration as alarming as well? And what reforms would you suggest to address that issue?
Well, of course it's a very serious issue because it's an enormous amount of power. And for a while, all these index funds got the feeling they were suddenly made godlike to clean up the world. But Vanguard has retreated from that policy, and I think wisely so. And I have some hope that Larry Fink will follow. I don't think it's smart for these index funds to try and influence the policy and politics of the country just because they're an index fund. I think they should be satisfied to eliminate some of the folly from investment management and do a better job for their clients, which I think they do very well. And I think they should be pleased with that and not try and run the whole damn country as a matter of corporate governance. I have no feeling that anybody at Vanguard or Larry Fink's operation has any special genius at how American corporations ought to be run. And to the extent they ask Berkshire to do this or that, I wish they'd stop.
Ask Berkshire to do what? To follow their guidance?
Yeah. I'm just not interested in their views as to how Berkshire should behave.
Now, if you like this video, don't forget to smash the like button and to subscribe to the channel. Thank you very much.